Most people think they understand how a nation becomes wealthy: more production, more trade, more investment, more growth. But what almost nobody realizes is that the same forces that make countries rich can also set the stage for their decline. And the greatest paradox is this: nations rarely collapse because they fail to create wealth. They collapse because they create too much of it, too fast, in ways their systems were never built to withstand. This contradiction has shaped the rise and fall of empires, the booms and busts of modern economies, and the fragile balance of today's global financial system. Yet the real mystery is not why nations get richer, but why the moment of greatest prosperity often hides the seeds of disaster. Behind every skyscraper, every stock market surge, every national boom, there is a story that quietly predicts the next crisis. To understand this paradox, we need to step back more than a century, to a world where global finance was still taking shape. Back then, wealth was created through land, labor, and physical goods. Currencies were tied to gold, trade was slow, and most economies operated in isolation. But even in that simpler world, the cycle of growth and collapse was already forming, because prosperity always encouraged risk, and risk always tempted leaders to push beyond the limits. As industrialization accelerated, governments realized that rapid wealth creation required more than factories and workers. It required financial structures strong enough to support expansion. This gave birth to central banks, institutions that could create money, monitor credit, and act as lenders of last resort. The Federal Reserve SA formation in 1913 was the turning point in this new era, giving unelected financial officials unprecedented power over national prosperity. But with new tools came new vulnerabilities. Money could now be created with the press of a button. Credit could expand far beyond real economic value, and governments could borrow more than ever before. These innovations supercharged growth, but they also quietly disconnected wealth from tangible assets. The global economy was becoming bigger, faster, and more fragile long before anyone recognized the consequences. World War I intensified this transformation. Nations borrowed heavily to fund the war, printing money at unprecedented levels. After the conflict, economies were exhausted, currencies were unstable, and debt was suffocating governments. This was the moment when the world learned its first painful lesson in the paradox of wealth. The same financial tools that help nations grow can also push them toward collapse when misused. The 1920s brought a brief explosion of prosperity. Credit flowed freely, markets surged, and millions believed they were entering a permanent age of abundance. But beneath the optimism was a hidden instability. Stock prices rose far faster than profits. Banks lent money they didn't have, and consumers borrowed more than they could repay. Wealth was being created, but it was the kind of wealth that evaporates at the first sign of panic. The Great Depression was the breaking point. What made the disaster so devastating was indeed just the crescit, was the realization that the entire system had been built on fragile, speculative foundations. Millions lost jobs, savings vanished overnight, and governments scrambled to restore trust. The collapse forced policymakers to rethink the rules, but it also reinforced a dangerous idea. When the economy breaks, the solution is always more intervention. After World War II, global leaders tried to design a financial system that would avoid another catastrophe. The Bretton Woods Agreement created the International Monetary Fund, the World Bank, and a world economy centered around the US dollar. On paper, it was a blueprint for stability. In practice, it concentrated power, encouraged debt, and gave nations incentives to pursue growth at any cost. For a while, the system worked. Trade expanded, industries flourished, and millions rose out of poverty. But the same pattern repeated. The pursuit of wealth pushed countries to print more money than their gold reserves could support. By the late 1960s, the imbalance was unsustainable. And in 1971, the United States ended the gold standard, unleashing a new era where money was backed not by metal, but by trust and trust alone. This shift fundamentally rewired the global economy. With no hard limit on money creation, governments could borrow infinitely, banks could take greater risks, and financial markets could expand without restraint. It was the beginning of an age where wealth was no longer produced, it was engineered. And like every engineered system, it carried hidden flaws no one wanted to confront. The 1980s and 1990s accelerated this trend with widespread deregulation. The belief was that free markets would maximize growth. What policymakers didn't anticipate was that unregulated wealth creation also amplifies inequality, speculation, and systemic vulnerability. Corporations expanded globally. Investors moved trillions across borders, and financial products became increasingly abstract and complex. This complexity created the illusion of strength. Nations appeared richer, markets appeared more efficient, and financial institutions appeared more sophisticated. But underneath the surface, the system had become frighteningly fragile. A small shock could travel across continents within seconds. A minor failure could escalate into a global crisis. Wealth creation had become a high-wire act, performed without a safety net. The Asian financial crisis of 1997 exposed this fragility. In just a few months, currencies collapsed, stock markets imploded, and entire economies lost decades of progress. Nations that had followed global financial advice suddenly found themselves trapped by debt, dependent on emergency loans that came with painful conditions. The paradox grew sharper. The more integrated the world became, the more vulnerable it became to collapse. Then came the early 2000s, when low interest rates and cheap credit fueled another wave of wealth creation. Housing markets boomed, banks lent aggressively, and consumers borrowed with confidence. Yet behind the scenes, financial institutions were packaging risky loans into products that few people fully understood. Once again, prosperity hid danger in plain sight. The 2008 financial crisis was the inevitable consequence. When the housing bubble burst, the shock rippled across the globe. Banks failed, markets crashed, and governments were forced to rescue institutions deemed too big to fail. What made this crisis unique wasn't the collapse itself, it was the rescue. Instead of reforming the system, leaders doubled down on the same tools that had caused the disaster: cheap money, easy credit, and massive government intervention. In the decade that followed, global debt skyrocketed. By 2023, total world debt surpassed $300 trillion, far exceeding the value of global GDP. This number is more than symbolic. It reveals a deeper truth. Modern wealth creation relies not on productivity or innovation, but on borrowing. Nations grow by accumulating obligations they can never fully repay. Central banks became the most powerful institutions on the planet. With a single announcement, they could trigger market surges or collapses. Interest rates, once a signal of economic reality, became a tool for manipulating growth. And every attempt to stabilize the system made it even more dependent on intervention. The pandemic amplified this dependency. In response to lockdowns, governments printed unprecedented amounts of money. Markets soared, even as millions lost jobs. The gap between financial wealth and real-world hardship widened dramatically. And when inflation finally surged, leaders blamed external factors instead of acknowledging the long-term consequences of their own policies. Today, nations find themselves caught in a silent trap. They rely on continuous wealth creation to sustain their economies, yet every new cycle of growth increases systemic risk. Debt keeps rising, currencies keep weakening, and financial markets keep expanding beyond their underlying value. It is a cycle that cannot continue indefinitely, and everyone knows it. The paradox is now clearer than ever. The tools that make nations wealthier also make them more fragile. The more money a country creates, the more debt it must manage. The more debt it takes on, the more vulnerable it becomes to interest rate shocks. And the more it relies on central banks, the less control its democratic institutions truly have. Some economists argue that the system can be managed indefinitely. Others warn that a correction is inevitable. But history suggests something more uncomfortable. No nation has ever escaped the consequences of runaway wealth creation. Empires fall, currencies collapse, and financial structures eventually break under their own weight. The real danger today is not a single event, but a convergence of pressures. Aging populations, geopolitical rivalries, energy transitions, supply chain fragility, and technological disruption all magnify the weakness of the financial system. A shock in one area could ignite a chain reaction across the globe. Yet the future isn't predetermined. Understanding the paradox gives nations the opportunity to address the underlying issues before they become catastrophic. The challenge is whether policymakers have the courage to act before circumstances force their hand. The first major takeaway is that sustainable wealth requires limits. Endless credit expansion, endless intervention, and endless debt accumulation will eventually destabilize even the strongest economies. Growth without discipline is not prosperity, it's a countdown. The second takeaway is that financial complexity does not equal stability. The most dangerous systems are the ones that appear too sophisticated to fail. Real economic strength comes from transparency, accountability, and resilience, not from engineered financial illusions. The third takeaway is that the global economy is a shared ecosystem. When one nation collapses, its shockwaves travel far beyond its borders. Cooperation is not optional. It is the only way to prevent a local crisis from becoming a global disaster. As we move into a decade defined by uncertainty, the world will be forced to confront this paradox. Will nations learn from history, or will they repeat it once again? The answer will shape not just the future of economies, but the stability of societies. If you found this exploration insightful and want to understand more about the forces shaping our world and the hidden patterns that determine the fate of nations, consider subscribing. The more informed we become, the better prepared we are for whatever comes next.